Alrighty. Hello, everyone. We're going to have folks trickling in, but if you are here for the Spring Forward with your credit and debt strategy, Life Money You podcast live event, you're in the right spot. All right. So, Sam Shannon, spring break, what's going on?
We're sneaking away for a couple of days just to get out of town. Nothing crazy, just a random house with a pool. We just want to swim. So
That
we found
sounds
this place,
nice.
yeah, a house with a pool. It's got a heated pool, so we were like, yeah, that'll work because it's still not quite warm enough down here in North Carolina to swim yet. So we're gonna have some fun with that.
And you
Yeah.
guys dealt with some snow this year.
Yeah, we actually got
So,
snow.
yeah, be nice to get some summertime activity. Not so fun on my end of things. I've got a 4-year-old and he's about to learn about spring cleaning. I can't
No.
wait. He's going to have fun at first, but wait until a little time passes and he's ready to play Transformers or something. I'm sure it'll be a combo. But I've had my windows open. I live in Indiana and it was like 70 degrees the other day and it,
Yeah.
it was fresh air. It was so nice.
Everything's blooming down here. The allergies are just brutal. So if I sound
Oh,
like a frog today, apologies.
Yep, that's where Zyrtec comes in, or Claritin, or whatever you take for those allergies. You got to
yeah.
build up the immunity. Um, Jazz, would you mind spotlighting Sam, Shannon, and myself, just so that we're all spotlit together? Yeah, I'm actually visiting our Vernon Hills headquarters, and Shannon, very similarly, it was absolutely gorgeous yesterday. I was
Hmm.
sitting out on the deck for my afternoon calls, and there was a breeze. I think it was 67 degrees, so it was pretty prime.
Yeah,
That's,
that is nice. Are
we
you doing
actually got
anything for spring break, Danny?
You know, I'm not. We
Yeah.
do have a wedding in Southern California that we'll drive down to, so that'll be a fun little road trip. But it's funny, just having dogs, no children.
Hmm.
Spring break doesn't really exist
I
anymore
know.
for me as an adult.
You gotta figure out what to do with them or if they're going along. I have a dog too, and we do it just park days, just getting
Yes,
outside and playing.
yes. And this looks great. Thank you so much for spotlighting Jazz. And with that, I'm going to go ahead and hop in now that we're 3 minutes after the hour. Welcome, everyone, to our Credit and Debt Strategy podcast live event. Just as a reminder for new folks and returning folks, we are Life Money U. We're a financial well-being program provided by BCU, a credit union fiercely committed to your financial well-being. These live events are intended to create a community of like-minded folks who are trying to build their financial confidence and learn more about certain topics. And today's is about credit and debt and how they are so closely intertwined. And we have two amazing coaches here today, both Sam and Shannon, who are going to talk through both practical examples and real life stories to help you get a better grasp on your current situation. And with that, I'm going to let Shannon introduce herself first and then Sam.
Thank you, Danny. So yes, my name is Shannon. I've been here at the credit union for a little over 6 years. I am a certified financial coach, and that is my favorite part of my job. So happy this is springtime is the best time to consider all of this, especially if you are a budgeter and you do like an annual review at the beginning of the year. Now's the time to really solidify your plans and reach those goals.
Hey
So,
guys, my name's Sam. I am an area manager for BCU. I too have been with BCU for a little over 6 years now. I am a dad of two boys and married for 15 years, so I know what it's like to deal with a budget and probably most of the things that you guys deal with that can be thrown at you, I've probably had thrown at me. So I love to share stories and help you guys create this financial strategies and just be really successful.
And I myself always learn something new in these events, so I'm excited for that today. And to kick things off, let's start with Sam, just breaking down credit for everyone here. We hear all the time how important it is. So, whether it's getting approved for a loan or an apartment or qualifying for just a better rate, what does the credit score itself comprise of, or what is it
Yeah.
made up of?
Yeah, great question. So, a lot of people think, oh, the credit score is just a mysterious number, smoke and mirrors. Nobody knows what happens, and then something happens. And you're like, why did it go up? Why did it go down? And nobody ever really knows. But I'm going to bring a little bit of context to it. So, your credit score is divided into five main buckets, basically, and that those five main buckets are what decides how your credit score is created. Your largest bucket is probably one of the most obvious buckets. It's your payment history. Do I make on-time payments? And it's just that simple. And that's 40% of your score. So that is a majority of your credit score. So when you do make a late payment, and when I say late payment, it doesn't mean that you're 1 day late on your credit card payment. It's when you hit that 30-day mark and they actually report it to the credit bureaus. So that's when you're going to get that technical late payment on your credit reports. But that can really weigh down your credit score. I've seen people's credit scores drop, 5 points. I've seen it drop 100 points just because of one late payment. It depends on, how much weight that credit account weighed on your credit score. If you only have two or three credit accounts, it's going to weigh more. Your second biggest bucket, and this is the one that most people miss out on, is your credit utilization bucket. So that's probably one of the most delicate buckets that there is because that literally changes on like a month by month basis. Because if you don't have any credit cards at all, a lot of people come to me and they say, "Hey, I don't have a credit card. I shouldn't have any bad debt." Well, you also missed out on that entire bucket on your credit score, and that credit utilization bucket that consists of about 26% of your credit score. So if you don't have a credit card, you have to have credit cards. You have to have revolving lines of credit to have a healthy credit score, and ideally about three healthy revolving lines of credit. But if you don't have the credit card at all, you don't get anything in that bucket. If you use all of the capacity of your credit score of your credit cards, you're using 100% of the utilization on them. You're maxing it out, and you lose all the points in that bucket again. So what you really ideally need to have is at least three revolving lines of credit that are responsibly used at less than 30% utilization. And then that will still fluctuate on a month by month basis. If you have like 10% utilization and you get a 13%, all of a sudden your score goes down 8 points or something like that, or it goes up 10 points. You're like, that could probably contribute to it. Your third biggest score, or your third biggest bucket out of all of those is your account mix. And basically that's just how many how many revolving lines of credit do I have, which is like your credit cards or lines of credit or something like that? How many installment loans do I have? And just making sure that you've got a healthy balance of both. Because if you don't have, if you got just 15 credit cards and you got zero installment loans, we can't really point to, when you apply for an installment loan, do you have anything in the history that would point towards you paying that back? So, that is another score that consists of about, I don't know, about 18 to 20% of your score. Your fourth biggest bucket, and it's just purely time bound, is how old is my oldest credits, or how old is my average credit account? And so if you've got old cards from like college or something like that, as long as you're not paying like an annual fee on it or something like that, keep that card open. Even if it's got a zero balance on it and you haven't used it in forever, keep it from going dormant. Put an auto payment on it or something, or buy a Coke or a tank of gas every once in a while just to keep it going. But I've got accounts that are like 18 years old now at this point,
Same,
and
yeah.
I don't want to get rid of them because if I pull that out of the mix, my score in that bucket's going to go down, and all of a sudden my average 15 years of credit age goes down to like 9 years all of a sudden. So that can make a big impact as well. And then the very last one, this is what most people freak out about the most, is the inquiries. That only accounts for 5% of your score. Inquiries aren't bad; they fall off after a little while. But when they're bad is when you're trying to apply for a new home and you're putting in an application for $300,000 house, and then you're also over here trying to get a $90,000 car and a $50,000 credit card. That's when the mortgage companies are like, that's probably not a good idea. That you're just shopping around for money at this point. But yeah, that's really how credit scores are decided. But the credit score doesn't just decide whether or not you get approved for a loan or not. It has so much more impact on you. Um, if you go down to Verizon and you want to get the new iPhone 17 Pro Max, they're going to do a credit check on you. If you've got a good credit score, you'll get approved for it, right? Or you might get approved for that really cool retro flip phone LG, from like 19, the indestructible ones from like 2000. Those are cool. I like retro, but not when it comes to cell phones. I like my smartphones these days. Um, you could go down to the utility. Maybe you got a new apartment. You go down to the utility company, get that electricity put in your name, right? Are you going to pay that $350 deposit, or do you have really great credit and you get away with a $0 deposit? that's a lot of money, that you have to tie up all because of a credit score. Or if you go down to rent the apartment and then they do a credit check for you as well, they're going to see if you're worthy to rent their apartment. That decides whether you get the apartment or not. That's just like one day's worth of errands that could possibly happen that if you had a great credit score, you wouldn't have to worry about, or you would save a lot of money. But that's kind of a credit score in a nutshell beyond just the that mystical number.
Yeah. I want to remind everyone, and thank you, Ashley, for your first question in our chat. But another part of these live events is to allow y'all to ask your questions. We have these coaches live and ready. I'm also a certified financial coach, but we're here to share our experiences and help provide examples for you to take advantage of your financial wellness. Ashley asked us the reporting part for credit. How do you know which credit score to trust or pay attention to? Sam, I'll let you take this one.
Yeah, so we here at the credit union, we typically use TransUnion, any of the three bureaus are reliable. I so you got TransUnion, Equifax, and remind me of the third one. I just drove blank.
Experian.
Experian, yeah.
Hmm.
So those are the three main ones, and you can pull free credit reports from each of those every year for free, and so you can actually see what they've got, and they're all going to report similar numbers likely. The only time I ever find a discrepancy is with FICO. FICO, to me, at least in my experience, FICO has always um, been inflated. So a lot of times, a lot of banks will use, oh, your FICO is 800, and then we go pull an actual credit report from Experian or something, and it's like, no, it's a 680. And so there's a lot of discrepancies there on how they create that. But I know that the Experian, the big three credit bureaus use that same five bucket scenario system when they're deciding those. So those can be used and they're reliable. In a lot of cases, if one is better than the other, then in a lot of cases we can use that other number as well. And it just depending if it makes a big difference on your pricing or not.
Yeah. Thank you, Sam. Shannon, I'm going to throw the next one your way.
Okay.
Melissa asked, what are our thoughts on freezing your credit?
In this day and age, it's a good thought. It's a good thing to do. It's an easy thing to do. Equifax, TransUnion, and Experian all have really quick, easy access tools to freeze and then unfreeze it really quickly if you need to apply for a loan or do something even with the soft credit pull. Like if you open membership with us, it's just a soft credit pull, but you do have to have TransUnion unfrozen. So definitely a good thing to do, and it should be a free thing for you to be able to do.
Yeah, and I want to add to that. It's great because it does help protect you from fraud. As long as you're not
Hmm.
planning to make any actions that require a credit pull, it's a great way for you to just keep your credit secure and protected from fraudsters who are attempting to pull credit with your information. Gosh, I love these questions, everyone.
Good,
Okay,
aren't
I'm
they?
going to move next to, let's see. We have Genesis. How does it affect the credit reporting if the oldest credit card goes dormant? Ooh, great question. Sam, I'm going to let you answer this one.
Eventually, it'll go dormant, and then they'll eventually close it out in a lot of cases where it'll show closed by lender or whatever on your credit report. So that will come out of your oldest age bucket. So, your average credit age bucket. So I would just be careful not to let them go dormant. Like I said, just make a purchase every once in a while. Buy lunch on it. Put something that you're going to auto charge every month on it, and just pay it off anyways. Maybe it's your cell phone bill, your internet, or something like that. But just something that keeps it live and active.
Yeah, I'm going to jump around some of our content topics, Sam and Shannon, but I think this is a great place to talk about strategic credit card use. So I know we talked about, right, our travel rewards, cash rewards. We talked about secured cards, right? Sam, can you talk around how you can strategically use these cards to really benefit your credit?
Yeah, so I like to keep so you got your cash, your live cash in your bank accounts, you got your debit card tied to it. I like to keep one mode, one step away from like fraudsters or anything. So when I'm using my credit card, Visa's going to go after their own money, a lot more aggressive than a lot, when you have a fraud situation. So I don't like people having access to my direct liquid funds. So I like to run everything I got through a credit card first. And the cool thing is that you will get that cashback rewards, or you'll get that travel rewards points. The optimal thing is to pay it off each month because even though you may be earning rewards, if you're paying interest on it, then you kind of cancel each other out. But I like to use the cash rewards. That's my favorite because you get liquid cash. You can cash it in after any $25 balance is put on it. But here at the credit union, that's a great way to build up some savings. But I like to let mine build up. So I make like 100. I've been trending out. I make like $100 a month in rewards off of it, which is really good because you just let it pile up on there, and then you're like, oh look, there's Christmas.
Awesome.
And then we transfer it over and we're done. But yeah, as long as you use it responsibly, make sure that you're using those accounts at 30% or less utilization. You're paying off the balance each month. But you can also be strategic too. If you, like, for example, with our travel rewards cards, you can redeem them for Amazon gift cards, which is fantastic because I mean, Amazon's king, right? And then on the cash reward side, cash is king too because you can just go buy Amazon cards if you want to, or just
Yep.
put it.
hmm
You can apply this credits towards your bill every each month. It can almost like help you make payments, on the balances that you spent, which is really nice. But yeah, as long as you use them responsibly, you can use them strategically. But that's what we're here for, to help you figure that out. So if you ever have questions about it, call us up. We'll give you perfect examples of how to use it, how to make it work for you, and just make sure that you maximize every bit of savings that you can.
Yeah. Shannon, do you have anything to add to that reply?
Yeah, I was going to say when it comes to using credit cards, especially when you're thinking about like the debt side of the conversation, you want to lean on those to earn rewards. Like Sam said, whenever you're spending, if you are not paying that balance off in full each month, you want to calculate what that true cost is for whatever it is that you're purchasing. But like Sam said, the credit bureaus like to see you use 30% or less of your total credit limit in order to effectively build credit. So, um, we have definitely had members who, maybe they're maxing out their cards and they can qualify for a personal loan where they can consolidate their debt into, a
Ooh.
60-month term loan. The nice thing about that is one, you know that you're paying it off in 60 months. That's not going to haunt you long term. But two, that might be a really quick turnaround to see a boost in your score. So if you're trying to position for like a home purchase in a couple of years, now's a great time to look into either doing that or maybe even leaning on the equity in your auto loan. I was speaking with a member the other day and he didn't realize that you could do a cash out refinance. So he had like a $30,000 vehicle on Kelley Blue Book. That's what it was worth on today's market. He only had like 12,000 left to pay off and he had credit card debt. So we did a refinance. He financed the full amount, the full Kelley Blue Book amount, and he just rolled his credit card debt into that. So it saved him a bit of money, and you might see a boost in your credit score in just a couple of months because, like Sam said, that is being reported on a month-to-month basis of, how much of your limit are you using each month. And again, Sam and I can have these conversations. You can bring your portfolio to the table to see, okay, what's my debt look like? What's my budget look like? And we can walk you through maybe your next one or two best steps to get you on your way.
Yeah, and
Yeah.
to Shannon's point, recharacterizing debt like that is so smart sometimes because if you can remember we talked about the credit card bucket, right? So even though we're not talking about specifically paying off all of your credit cards, if we just recharacterize that credit card debt from the credit card bucket and put it into like a personal loan, like what Shannon
Mm-hmm.
was talking about, or with like a title loan or something where we were cashing out money on his car, it's taking that all those balances out of that 26% bucket and pulling your utilization from like whatever it was, maybe it was 50 or 60% all the way down to zero. And the coolest thing is that in 60 days, that's going to reflect on your credit score. So you might see 100. I've seen so many members have like a 60, 80, 100 point jump in their credit score, which then in turn allows you to get better interest rates on your loans. So the cool thing about the credit union too is that on top of that, not only do we help you get that higher credit score, we recharacterize the debt, we do these strategic things for you. We can go back into your loan that you got. For example, Shannon used that auto cash out example. Maybe at the time that we did that cash out refinance for him, that we got him into like an 8 or 9% interest rate. But then his credit score upgrades from like a 650 to a 750 or 780 or something. Now all of a sudden he qualifies for a better rate on that
Yeah.
loan that he got. So we can go back into the loan and do a rate modification, which not a lot of financial institutions do that these days. And we can give him the interest rate that he qualifies for with the new credit score and bring his payments just solely bring his payments down. We don't have to refinance. We have to do another credit check.
So
It's a
cool.
workflow we run on our end.
Yeah. I'm going to keep going to the questions. So we're going to
Yeah,
hop
yeah.
back and forth. Eric asked, does it really take 7 years for a late payment to drop off your credit score? Shannon, I'll let you take this one.
Yeah, it does. However, the further away you get from that late payment, the less of an impact it has on your score. But yeah, the negative type of reporting does stay on your report for 7 years.
In a lot of cases too, like when you put that application in, like if you were to talk to me or Shannon, we put an application in for you, you can say, hey, I missed a payment because of this one time. If we can put that in the notes so the underwriters know. And then I mean, if it's not like a habitual trend, we're not going to hold it against you. Yeah, it does pull your score down from what happened, but we're not going to be like, what happened right here? What is this? If you can explain it or something like that, then I mean, it's not that big of a deal. So it's not detrimental in terms of an approval process.
Awesome. And Sean asked, would you recommend taking out a personal loan to pay off high credit card debt or using one of the debt pay down methods?
Combination of both.
Yeah, there
So
you
yeah, look,
go.
I'm a know your resources type of person. And that's what I love about the financial coaching aspect is, you can have these conversations and really talk one-on-one about your best options. You want to look at the overview of, maybe you'll save an interest over the life of the loan if you do roll it into a personal loan. Again, you have that benefit of knowing that you're going to pay it off in a certain amount of time. But both of these conversations, the debt conversation, the credit building conversation, it all starts with your budget. It really does. So how much can you put towards your monthly payments? Obviously you want to meet your minimums, but how much additional can you put towards it? And Danny, I know that we had it on our roadmap to talk about like 0% offers on credit cards and doing balance transfers. That's a game that you can play. But anytime that, and if you're not familiar with it, there are cards out there that have 0% APR offers for a limited period of time. Like we've got two of them where you have a 0% APR for the first 12 months. So you could do like a balance transfer to move your balances over to the 0% card. For us, it's a 3% fee. So you really want to math it out. Put your budget on paper, put everything on paper, and the data will show you the way. But you want to math it out and make sure, okay, what does my budget look like if I have 12 months to not accrue interest and just really focus on paying down my balance? How much can I realistically put towards that each month? And can I keep myself honest? We've had some hard conversations with people who do a balance transfer and then they don't keep to their budget. And at the end of that 12-month period or whatever month introductory period, now they have the same amount of debt, or a lot of the times what we see is more debt, and they're just stuck in that higher interest debt. And when it comes to like your credit score, and you might not be approved, maybe you've done 0% balance transfers for three different times, but that fourth time you might not get approved. And if you're not approved, then you're just stuck in that higher interest credit card debt. So it's a dual conversation and both are worth looking into.
And just to give some context on like how much money you can actually save, to Shannon's examples, if you've got a $10,000, I don't know, store card at, I don't know, we'll call it Best Buy, they and you can probably rack up 10,000 bucks pretty easy with their TV and an Xbox, and we're talking about 10 grand, right? But then the thing is, though, if you've got a $10,000 balance over there and you're paying 25% interest, which is typical interest rates for like a big box store like that, you're paying $2,500 a year in interest. So think about that much savings. If you were to do a balance transfer over to a 0% for the first year alone in interest, you're saving 25% of what you would have paid on that balance over there. So you're getting a huge jump, and that's not even talking about the principal payments you would have been making. So you can really pay down interest or pay down your balances a lot quicker with a balance transfer, as long as, like Shannon was saying, you use them responsibly. When I do that with members, I always tell them, I always advocate for the balance transfer first. If they're in a position to do that, because you get that 0%, nothing's better than free money, right? So doing that is going to save you the most amount of interest. But then what I like to tell them too, at the end of a year, you make these great payments, let's keep the credit score up and we'll make sure we tweak it wherever we can to keep that credit score up. If you still have a balance at the end of a year, at the end of that promotional period, let's roll it into a personal loan at that point. So at least you can take 12 months of 0%, and then we can get it into the installment loan, which then that pulls it out of the credit card bucket, right, on your credit score. So now we're talking about everything going up. Your debt's going down, your credit score's going up, you get into a payment plan that works for you. But yeah, that's a great examples.
Yeah. I'm going to pivot just a slight bit. Some of our questions are talking about student loans and students saving for college or trying to build their credit. I like to say that we actually just released an episode about higher education and financial wellness. So go tune into that. We also have an episode from last season about minimizing student loan debt. Um,
That one is so
both of
good.
those. It's so good. There are
It's so
so many
good.
cool ways. But without getting in too detailed, I'm going to ask Shannon to answer what is some advice for college students trying to build their credit?
So there are a lot of young adults are leaning on secured credit cards. So that is where you're bringing the security deposit to the table, and your credit card limit is going to be what your security deposit is. We have a card that has no annual fee. The security deposit is refundable. So, if you have that card open until you can position for maybe like an unsecured rewards card, you can close that card out. Always have a conversation with a financial coach before you close any credit cards out, just because, like Sam mentioned earlier, it might have an impact on your score, but it might be worth it just to get your security deposit back. But lean on things like that where you can focus on building credit and have that positive payment history that's reported to the credit bureaus as you're getting started with your adulting life. And then I will also say we also have a personal loan whose sole purpose is to help you either establish or rebuild credit. So, like Sam said, there are lines of credit and then there are installment loans that the credit bureaus like to see reported. So, that ticks both of those boxes to help you build credit.
And the cool thing is too is that we realize that poor college kids ain't got a bunch of money, so it doesn't take a lot. It doesn't take a lot to get started. So we can actually design the secured lines of credit or the secured credit card. It's only $150. It starts at 150. That's the minimum security deposit. A lot of those out there nowadays are like 300 or $500. That's a lot of money to tie up when you're 18, 19 years old, getting going into college. And then of course too with the credit builder loan, we can design payments down to like $30. And what happens is you make those payments into the loan, and at the end of the loan term, you get a majority of that back. As like a thanks, you've made it here to the finish line. Let's give you your savings back. So it's kind of like a forced savings account, but it counts on your credit score as an installment loan. So you get the best of both worlds. Savings plus a loan completion.
Yeah. You know what you made me think of? Another topic we have, but I'm not sure if this audience has heard of buy now, pay later solutions. What's interesting is that if you pay, let's say, it's okay. First, let me describe what it is. That might help. So you're shopping and you see that instead of $100 for that really cool gadget you want to get, you could make four equal payments of $25 instead. And so you're like, ooh, that sounds a lot nicer. What's interesting, and I want to let our coaches dive in a little bit, but if you make those four equal payments, you are not going to be contributing to your credit score in a positive way. However, if you don't make those four equal payments without that interest, you will affect your credit score negatively. So with that, again, I'm not sure if anyone here is using buy now, pay later. When used correctly, it's successful, but when it is not, it can be hurtful. So, Sam, I'm going to let you run with this one a little bit.
Yeah. Yeah. So, okay, I finally broke down. I tried it the other day. And, so you got like I think Amazon has a firm, and then the other, I saw Klarna, which was mentioned in the chat
Hmm.
there. And they're cool. They're cool if you use them responsibly, but they also with great power comes great responsibility, right? Let me quote some Spider-Man here. But yeah, so when you're on there and you're shopping, I'm like, oh wow, that's cool. I can make three or four or six, or they got different payment plans you can do, but you have to really eyeball them because sometimes on specific items it'll say, oh, this is an interest-free payment plan. And then some of them say, oh, this is a 10 to 36% interest payment plan. And so it'll break it down, but you have to really pay attention to it. And just a lot of us, we all, anytime there's terms and conditions, what do? We scroll to the bottom, hit accept, and then get me through it. I'm not reading through 97 pages. I read like at least through 3 pages there. But yeah, so it'll tell you how much interest you're going to pay, and it's a minimum of 10%. So on some of them are interest free. It just depends on the item and how much you're spending and all that kind of stuff. But like Danny was saying, it does not report positively on your credit accounts, but it does report negatively. So if you're getting to that 30 to 90 to day late, it's going to report as late payments, and it's going to
Yep.
report as a collections account eventually if you don't pay it off. But just be very careful with it, especially if you're like one of those that becomes a habitual buy now, pay later, and you've got like nine of them all of a sudden, and then that you've got a car payment's worth of buy now, pay laters that are really weighing on you because you've gotten the item, you've used it, you're not going to send it back.
Hmm.
You own that now, so yeah, and some of them go out to like 6 months, 12 months, and I even saw some of the limits would go almost out to like 14 or $15,000 on something.
Crazy.
Could you imagine a $15,000 buy now pay later? It's buy now pay forever.
Hmm. And let's say you can't, let's say it eventually isn't working for your budget and you can't keep up. A lot of them are going to tack on all of that. Maybe it's
Yeah,
interest free to begin with, but if you start missing your payments, they're going to tack that interest on.
yep.
So
Exactly.
it's not just going to be that four payments of $25 that you've missed out on. It's going to be more than that you owe.
And late payments. Or
Hmm.
Yeah.
they had fees, like late fees in there.
Yes. Yeah. So just one, we'll sprinkle in some cautionary stuff with modern day transactions, but that's just one that comes to mind. I'm going to move to some more questions. So Kristen asked, what is the difference between a regular credit pull and a soft pull? I'll let Shannon take this.
So the soft pull, from my understanding, it usually has more up-to-date data. So, like if you do a credit card um, into an installment loan, if you consolidate that way, you might see that on your soft credit pull quicker than you'll see it on the hard credit pull. But think anyone can pull a soft credit pull on you. So like whenever you open up membership here, it'll be a soft credit pull. Whenever you maybe apply for, or maybe whenever you're applying for housing, a lot of the times that's a hard credit pull, but utilities might be a soft credit pull. So the hard credit pull, you're giving permission for. The soft credit pull, anyone can pull on it. And it's just more limited data that they're seeing there. Sam, add on to that if you can think of anything else.
Yeah, so and the hard pull is going to be the one that actually affects your credit score. So that's going to be
Hmm.
the one that drags it down 4 to 5 points typically. It's going to be the one that actually shows up as an inquiry on your credit report. The soft pulls do not show up. They're just kind of like a just what it is. It's a soft pull. It's not like an actual pull of your credit report. They're not reporting it to the credit bureaus that you're shopping around for credit or anything like that. So those are easy to do. And that's what a lot of services like for example, we have Savvy Money Credit Score built into our online app, which will use a soft score to give you a live credit score whenever you want, but it does not affect your score at all. Hard pulls are usually associated with actual applications. So if you're applying for a car or you're applying for a credit card or something like that, that's when you're going to hit those hard applications or hard inquiries. You do have to be careful too, like when you go to an auto dealership or something like that, they might run your credit like 8 times sometimes. So be careful when that happens because I've seen that, have come back with some pretty big drops in people's credit score before.
Yeah. Yeah. And I'm thinking of equity right now, but a very similar question Deborah asked. I'll give this one to Sam. If you have a paid vehicle, is there a way to use that value as well?
Yeah, that's an awesome question. 'Cause so they call that a title loan. And so basically what we go in, let's say you've got a 2020 Toyota Camry, you've paid it off, and all of a sudden you're like, man, I need $10,000. What we do is we go in there, you give us the VIN number, the mileage and everything. We value the car, and let's say your Toyota Camry is worth $20,000 still. We can lend up to $20,000 on that car again. They call it a title loan. So basically you're refinancing the car and getting the cash out of it. So basically, we would just give you a $20,000 balance. We put our name on the title as a lien holder on it. We hold the title until you pay it off, just like you were getting a car loan all over again. So yeah, that's a great way, and that's also one of the cheapest ways to get money as well, or to do lending and financing because that's called a secured account. So it's secured by that property of the car, and so your interest rate's likely going to be way, way, way less than that of like an installment loan or like a credit card or cash advance or anything like that. You're probably talking like sub 6 or 7% in some cases versus like teens and 20s on like cash advances or installment loans. So huge difference there because the property is what's securing that loan.
I have a good example of this. I actually just worked with a member on this. He was going to do a personal loan and he was going to be around 17%. He had a vehicle that he owned outright and we ended up going that route and he got 10%. less on his interest rate.
Wow.
So he just had like a major life event going on. He thought he was only going to need this loan for just a few years, but he actually went out to 75 months because we don't charge people for paying early on their loans. So if you're looking into that and you think, maybe I don't need it for the full term that I would normally do an auto financing for, that's okay if you know that you can pay it down without any prepayment penalty. But he was also, like his vehicle's a little bit older, he included an extended warranty and a prepaid maintenance policy. So a lot of financial institutions, us included, you can get some of those same dealership protections, usually at lower cost, lower value. So or higher value, lower cost. So um, his overall plan was, okay, I've got, major breaks. It's built within my monthly payment, so it's not going to break his budget if something comes up. He's going to lean on this for a solid 2 years if he needs it, but if he needs to go out to that 60 or 75-month term, he absolutely can. And he knows that it's within his budget to do so. So again, like if you guys ever want to dig into the budgeting talk, the debt consolidation, if you just want tips and tricks on how to maybe boost your credit score, our whole financial coaching team is here for that. And we've got a lot of them here at the company. So lean on us.
And I'll continue to tout that because as I'm scrolling through our chat here, again, love your questions. Keep
You
them
guys are
coming
so
in.
active in
If
the
we
chat.
don't,
It's so good.
again, we will find a way to get to you, but try to get to us so we can help make it easier. Again, our technical host will drop the link to schedule time with either Sam or Shannon in the chat, but some of y'all's questions are very detailed. And so in order to give really good responses from our coaches, I think it requires a more one-on-one conversation. That does not mean don't drop your questions in the chat, though, because the person online next to you might also have the same question. So keep them coming. On that note, however, we're talking about all these different loan options and which is the best for your situation. I'm going to ask a question from an anonymous user. Is a 401k loan a better choice than a personal loan to pay off credit card debt, especially if they are similar interest rates at 9.5 to 10%? I'll let Sam take this one.
I always think 401k loans, in my opinion, are probably the last option you want to do. That's kind of like the Hail Mary when you've run out of every other option. I would most definitely take anything else over that just because you're losing out on so much potential in terms of, yeah, the interest rates are similar, but what were your returns on the 401k?
The
So
magic of compounding interest. You're
yeah, so
missing
you,
out on all of that.
exactly. So yeah, so that's you got to think, in 60 months, what would I have made off of that? Especially if you got if you're in one of those high risk 401ks like I like to roll the dice on and you got like 15-20% return sometimes that's a lot of money because then you're
Yeah.
paying interest and then you're losing the gains. So I mean you might be paying like 30% in the end.
And
Yeah.
also the fine details of that loan that you take out. What happens if you're let go from your job?
Yeah.
Most of us are not planning for that, but that loan might be due in full within a short period of time after you're no longer working there. And if you can't pay it off in full at that point, then it's going to be a withdrawal with all of those taxes and penalties
Yeah.
stacked onto
Then
it.
you got a 20% income tax on
Yeah. Yeah.
that. Not
Yeah.
cool.
Yeah, yeah, definitely be cautious of that one. Kristen asked, will there be talks of more student loan debt payoff? We love it. She actually mentioned both the snowball and avalanche. So, Shannon, I'll ask you, is there a better strategy when it comes to paying off student loan debt, the avalanche or snowball method? Which would you recommend?
It depends on you. So generally speaking, paying down the most expensive debt first is the most financially advantageous because you're going to pay less in interest over the life of the loan. Again, put all the numbers on paper just to see, what does the interest payments look like over time. But a lot of us need to see some
Progress.
some movement, yeah, some
Yeah.
progress to stay motivated. So if that's what you need to cater to make sure that you keep yourself motivated to pay it down, then do so. And then of course, even with these, you want to look into like refinances if it works out in your favor, but keep in mind that if you have federal loans, some of those might have additional benefits that if you refinance to a private lender, you're not going to have those any longer. So you just really want to make sure, like before you make any changes, you want to know what you're leaving behind and what you're getting into.
Awesome. I'm going to go back to our kind of topics here. So, I know we wanted to talk through just some cautionary tales, right? So, there is no quick fix, right, when it comes to your credit and paying off debt. This is a journey, and we're here for it with you. So, I'd like to pass it to Sam to share one of his cautionary tales when it comes to building credit.
Yeah, building credit's definitely going to be a journey. It's not something that you're going to, I mean, in some cases we can make tweaks that will, get your score to boost up. But when it comes to like, if you're recovering or trying to build credit or something like that, a lot of it's going to be time bound in the beginning. So you really want those positive payments on the front end. You really want to be aware of where your money's going. If you don't have that awareness, you're never going to even know where to start. But awareness is one of the biggest things that I like to bring to the table when we start having these conversations because using like like a spend and analysis tool to see where your money's going. There's so many times that I've talked to people where, they're in a situation where their credit's bad, they're having problems making payments, they're trying to dig out of a hole, and they don't have any awareness of where their money goes. And then all of a sudden, we start doing these epiphany conversations of like, oh wow, I spend $300 a month on Uber Eats, or I spend $400 a month on whatever it may be. And so having that awareness of where your money goes, you can start transition from making like singular decisions of, oh, I just want to eat out on Tuesday night. It's not a big deal. Uber Eats, whatever. Or you'll start making or you'll start making decisions of, oh, I spend $300 a month on Uber Eats. Do I need to eat out this Tuesday night specifically? Or do I, so you'll reset your mind about your budget without actually even having to put a budget on paper. Just but gaining that awareness of where does my money go? That's the first step in creating that awareness and on your financial journey. It's definitely a process, but once we start getting you on track and finding those places where you can start building savings and starts cutting some of the spending, that's going to give us the opportunity to really start building that credit with the on-time payments and with the budgeting and with the awareness and the confidence and everything going from there to just snowballs all the way down into great credit scores, good payment history, good habits. Once we get those established, we're here for that. The financial coaching is absolutely free for you guys. Anybody who wants to call us up, you don't have to pay anything to do that.
Hmm.
It's completely free. You don't even have to have a membership here with us. If you know your finances is good enough, call me up. You can name all your finances. We'll put them on paper. We'll have a conversation, and then we'll see what you want to do. We'll always give you options, and then we'll never pressure you either. But that's just what we're here. We're not for profit, so we're not looking to make money off of you. We're looking to make sure that you're financially successful. Successful.
Wow.
But yeah, at the end of the day, whenever I hear those success stories of like, hey, you helped me do this, or hey, here's a picture of my new ride because I was able to get a good credit score.
Yes.
It's super rewarding for us on our end, but that's our main goal here.
Sam, you answered like three questions at
Did
once.
I?
I'm scrolling through. I'm like, who did I miss here? And you're
I
like,
saw
check,
that one.
check,
I was like,
check.
I've got to say that the financial coaching's free.
Oh gosh, I love it. Aubrey asked, is placing a fraud alert with the credit bureaus helpful if you have not placed a freeze? Shannon, I'll pass this one to you.
It is. So anytime a hard credit pull happens, if there is a fraud alert, the financial institution sees that. So you put the best phone number to reach you at, and then we call that number separately. So you'll submit your application. We'll see that number listed. We'll give you a call and say, hey, are you submitting this application? Is this legitimate? And then you'll confirm yes, and you move forward from there. So it's just an extra step that the financial institution has to take before they open up a loan or whatever it is in your name.
Yeah. Ashley, really great segue. So we had some content ready for just like lifestyle frugalness, right? And how we can maintain the quality of life we want while saving more money. And so I'm going to pass it to Sam to start with utilities and insurance shopping. He always brings up these topics when it comes to saving more money.
Gotcha. Yes. All right. This is my favorite part. Um, Utilities. So trend out your utilities. If you're not on like an equal pay plan or something like that with your utility company, try to see if they've got one. Be aware though, when you do an equal pay plan, typically in January of every year, they're going to recalculate, did they use more or less than the average last year? And then you're going to have a bill due that January for, an extra $200 or something like that. Mine has steadily gone up, as my kids leave more and more lights on in the house over the years. So that's a really good way to do it, but also trend out seasonal costs of your utility. So if we don't use depending on where you live. Here in the South, we don't use heat or air conditioner usually that much in like
Lucky for you. A lot of us
September,
are
Hmm.
up
October,
north,
right?
Sam. Okay, keep going.
We can get away sometimes. It just depends on what your comfort level is. But your utility bills are a lot less in like September, October, March, and April versus those hardcore Decembers and that middle of the August where it's like blasting and cold air all day. So trend those out. I usually recommend trending out for a year. If you're paying on a month by month basis, trend out your utilities for a year. Trend out any of your seasonal costs for a year so that you can put that into your budget. So you can say, okay, on average, I spend $150 a month, even though September might be $60, but then December's 300. So definitely look at that. One of the things too is that bundle what you can. If you can bundle, there's so many ways that you can do some great bundling. One of my favorite ways of bundling is going through Verizon. So yeah, I pay a little bit more for a Verizon Unlimited plan. Cool, whatever. But the cool thing is that I get, Hulu and Netflix and all these things for either reduced costs or if you've got one of the old plans, see if you can still get those old school grandfathered in free ones. I used to get Netflix for free and Hulu and Disney Plus, all that stuff for free. So if you can bundle anything like that, I think the first year I started bundling all my stuff, I saved like 600 or 800 bucks in a year. Your internet, for example, you think I'd work for Verizon, but Verizon has a 5G internet box that you just get. You don't have to have a guy come out to your house and wire it up for fiber or anything like that. You just plug this box into the wall. It broadcasts a 5G Wi-Fi network. I do all of my, webinars and everything on it. We've got the Nintendo Switch in there blasting and all of the other streaming services at the same time. So it's not slow or anything, but I get $35 a month on that. And it's locked in for 10 years. I get 10 years of internet for $35 a month.
That's huge.
Yeah, so I was paying a
I
hundred
need to
bucks
do
a month
that.
for that cable, whatever,
Hmm.
from whatever the other place was. And that's $65 a month that you're saving just in one bill. So
Seriously.
keep in mind too that your dollar at one company might be $2 at a different company. If you shop around a lot of times you can get better deals for moving, welcome customer kind of things, whatever that may
Especially
be.
in spring, right, Sam? You said
Yeah,
especially in spring. Yeah.
exactly. They're looking to make some deals and they'll negotiate and don't be afraid to call them up and ask for a deal. I
Yeah.
had people come out for the garage door the other day. I was like, "Hey, can you do it for half that?" And he's like, "Yeah, yeah, cool, of course, no big deal." I was like, "All right, I got my garage door service for half the price." But yeah, be a haggler. Be a haggler and start asking for better
Yes.
deals. Even if it's like a big company, don't be afraid to call up customer service and ask them for a one-time exception. That's the term they like to use. Can I get a one-time, exception just to, get, a year's worth of internet for $10? And they may give it to you just to keep you as a customer. But shop around for insurance. If you've had your auto loan insurance for multiple years, I flip-flop between Progressive and Geico like every 2 years because they're the least expensive that have a brand name behind them, but you can get into the bottom of their pricing structure. Every time your policy renews, it's like, oh, it's an extra $50 this year for insurance or extra $60. But that happens 2 or 3 times, all of a sudden you've got $300 or $400 tacked onto your premium. If you switch companies every 2 years, you get back into the bottom of their pricing structure. You get those welcome back customer discounts, and you're like, yeah, I'll be there for like 2 years. So welcome back for 2 years. But yeah, shop around, look to spend your dollar the smartest way that you can. Um, but there's so many ways. That's just my main ones. If you guys want to call us up, set an appointment, we'll get into the weeds on it. We'll start talking
Hmm.
about some
Yeah.
really side
Yeah.
hustles and all kinds of stuff you guys can
I
do.
I
know,
do this.
Shannon, you have a bunch to share, but I want to really quick.
Yeah.
You see, all of these are recorded, yes, and they are on our podcast. So, again, just as of this year in January, we started translating these specific episodes as well as others, right? That we don't do live with video. We just record like podcasts do. So, if you go to Life Money U, Apple Podcasts, you can listen to this one as well as all those other segments I mentioned earlier, the minimizing student loan debt, the mortgages and insurance, the higher education and financial wellness. So, all of these and so much more are housed on Life Money U podcast. So, go there, subscribe, and you'll be informed of all our new episodes. Shannon, please keep talking about frugal lifestyle because I know you have more.
Yeah. My family, we are single income purposefully. I've got a 4-year-old. My husband stays home with them. So we are natural homebodies, which that makes it a little bit easier to kind of keep the costs down. But every single thing that we do, we're really weighing, like, is it worth our money to us right now in this moment? I did want to point out that outside of, so think about your employee benefits. Everyone usually leans on their health, dental, vision, but there's also your employer might have like some daycare support in your area that you can take advantage of, or maybe you're trying to get your will established. Maybe they have, a discount on legal services that you can use. So always just make sure to know the resources that you have, both at your employer, but also in your community. We go to our library all the time. Use your local library if you are lucky enough to have one that you can use. Um, they've got toddler classes that we use all the time, but I like to knit and crochet. And there's also like craft classes that I can get into. You can also rent like games and sports equipment and things like that. So just lean on the resources that you have available. And then for us, groceries is always the big thing that we're trying to cut back on. I feel like I'm probably not alone given the chats
Nope.
that we've had
Yes.
before, but we're always trying to shop the sales and shop multiple stores and things like that. But even when it comes to like holiday spending, it is not uncommon for us to celebrate after the fact. So Valentine's Day just happened. We bought a bunch of chocolates half off right afterwards. And then we set up our own like taste test. So my son and I created like a little organization chart and we taste tested everyone and rated it 1 through 5. He was a 5 across the board, which was pretty funny. Like not surprising, but pretty funny.
Chocolate's chocolate.
Yeah, yeah. But that's probably going to be our new thing. And it's much cheaper and it's still fun. You're still creating those memories. So don't hesitate to think outside of the box or just, do what works for your family, even if it's not the traditional way that most people celebrate.
I love that. So I will say we have covered so much in such a short period of time. And as we have reiterated, Shannon and Sam are here. They're waiting. They're
Hmm.
ready for your appointments, ready to talk to you one-on-one and get even more personal with your situation. I will say, just to leave our listeners, Shannon and Sam, if there's someone out there feeling very overwhelmed, they have all this info now, but they don't know where to start. They want to boost their credit quickly. They want to start making big strides in paying off debt. I'll let Sam take this one first, but what is one thing you would leave that listener with to help relieve them of any of that overwhelming feeling?
Yeah, that's a question I get all the time. People call up and they're like embarrassed about their finances or something. And I always tell them, you're an expert at what you do. I'm an expert at what I do. I'm like, if you go to the doctor and the doctor doesn't know what your symptoms are, how can they, diagnose what's going on? So never feel embarrassed ever.
Great
I
analogy.
guarantee you, me and Shannon have been in it long enough that whatever your situation is, it's not the worst situation we've ever heard of, and there's nothing to be embarrassed about. Some people don't know what they don't know, and so asking those questions, that's what we're here for. I'll take you from like whatever level you have in terms of your financial knowledge. I'll take you from whatever that is. I'll bring you up to whatever I can get you to. I'll teach you everything I know about whatever topic you want to talk about. But it's a fun experience. It's never judgmental. It's never any of that. Never come to the table with reservations with us. We're probably the easiest two people to talk to on the earth, especially when
I
it comes
can
to like
attest to
finances
that.
and stuff. Like yeah, easy to talk to. It doesn't have to be serious, and we can just have a 10-minute conversation typically, and just kind of get a really good understanding of what you have going on. And the nice thing too is that we're not just the people that give you information or anything like that. We're the people that actually are going to handle your finances for you. So we would build that relationship with you. We would know you years down the road. I've had so many people go through like huge life events of I'm saving up so I can be a mom and dad now, and then all of a sudden they're like, hey, here's my new baby, and then it's really cool. But yeah, we're here for you. We're here for you in every regard.
And
Amazing.
that's my ad is schedule your financial coaching appointment and know that, like we mentioned earlier, it is a process. So it's for a lot of people, it's not going to be a quick fix, and that's okay. But what these financial coaching sessions are free. You don't have to be a member, and we can hold your hand as much or as little as you need us to. So I have some members who they like to check in once a year. I have some members who are really trying to focus on budgeting and they want to check in every 6 weeks. And that's okay. You guys will reach out to us. We'll get you our scheduler link, and you can just throw a 30-minute chat on our calendar whenever you want to. But what we can do is, thinking this is a long-term plan, we can have a large scope. of, okay, this is what we hope to do within the next year or two, but also what is that next best step? What's that one thing that you want to do right now to get on your way? And when you break it down into those smaller sections, that's where the overwhelm kind of relieves itself a little bit and you think, okay, this is my next actionable step. I'm going to focus on this, and then we can talk again to talk about that next step. So let us take, not to say that we're going to take all the burden off your shoulders, but we'll take some of it off there and we'll help
Yeah.
create that roadmap that is truly yours.
Yeah.
And the other thing, too, I just want to add one more thing. It always helps to have somebody in your corner when it comes to like finances. In a lot of cases, it's always like, at least in my experience, I've always seen like it's everybody versus the banks or everybody versus whatever it is. But when you've got somebody like me and Shannon, we fight your corner for whatever we can. We're going to make sure that we're your financial advocate when it goes to doing an auto loan application or a personal application or making sure that your finances are set up correctly, your budget or whatever it is. But having somebody to fight in your corner like that goes a long way, even if it's just to support or advise or whatever it may be. That's exactly what we're here for.
Yeah, definitely. And I can add to that, right? Not everyone is going to be your best accountability partners, but the folks you have right now here in front of you are experts, certified, and have your best interest at heart. So, a great example for me is I'll use the name Sally, but her name's not Sally. Whenever I'm having a hard time emotionally, and she is too, we'll get together and she really wants to go shop, right? She really wants to go get something new, and then we'll feel better temporarily. But instead,
Hmm.
if I were to call maybe Sam or Shannon and say, you know what, I'm not feeling well, I'm really being tempted to go do this or that, what can I do instead to get the same amount of relief? I guarantee you they will be able to help me through it in a way that's not going to make me feel awful. And I will not be financially hungover from whatever I do to help myself feel better in that moment. Um, we were asked, is the podcast only available on Apple? No, we're available on Spotify as well as Buzzsprout, which you can visit our website at lifemoneyu.com, listen to any episodes there. And we're on season 3, guys. So we're building a lot of traction here with the podcast. We know you are busy right now. Many of you right now listening are probably doing something else while you're listening to us. And we're fully aware of it. We
Hmm.
love to multitask too, but that is why we wanted to make ourselves even easier for you to engage with, and that's via the podcast. So please subscribe. A couple closing notes here. We are Life Money U. We're the financial well-being program of your credit union who is fiercely committed to your financial wellness. We not only offer content and tools like our podcast and newsletter, but we have a fully staffed team of certified financial coaches, just like Sam and Shannon, who can help you relate to your money and take full control of it so you can get that much closer to your next financial goal. I will say that membership is free. And one
Hmm.
thing I really want to make known is even if you don't want that new product, that new savings account, our digital banking app has so many solutions that Mint, now retired, Rocket Money, Acorns, all of those really cool, savvy financial wellness apps that you're using. We have it in digital banking, and you do not need to engage with the product to be able to use it. You just have to become a member, and that's free. So, really, again, leave with that peace of mind. If you just need a new tool, we're here for you. If you need a person to help you, we're here for you too. Sam, Shannon, any last closing thoughts before we say bye to our audience today?
Don't hesitate to reach out. We're here.
100%.
Yeah,
Yep, that's the
whatever
best
it
part
is you
about
want
it.
to talk about, you bring it to the table. If you want to talk about our products and services, if you want to dig into the financial coaching, if you want to explore what a refi might look like, but you're not ready to commit to that hard credit pull, we have all of those conversations. Sam and I have our hands in almost everything. And if we don't, we've got a favorite that will point you
Yeah,
We all
we
towards.
have
do. We have a
favorites.
Yeah,
whole list of
yeah.
favorites. But no,
All right.
I echo what Shannon said. Just make that appointment. Give us a chance. Give us a chance to see what kind of difference we can make in your financial lives.
Yep.
Love it. And July 1st is our next scheduled event like this. I will say between now and then, subscribe to the podcast because we have episodes queued up and ready for you with more information like this. Heck, you might even hear Shannon or Sam's voice as well as my own on one of them. Thank you all so much for joining, and we look forward to seeing you at the next one.
See
Bye.
you guys.
Bye, guys. Thank you.